Hello everyone and Assalamu alaikum from Dubai here. Today, myself Hitesh Shah and I have with me Ajit Jain in this podcast, and we are going to discuss basics of transfer pricing. So as you all know, transfer pricing as a subject is not alien to the taxes world. Across globe and across the developed economies where the taxation has developed, transfer pricing is embedded in the tax law itself. But when it comes to UAE as a jurisdiction, forget about transfer pricing. The corporate tax itself is an alien subject, and the industry here has started implementing it. So now it becomes really very important on how this subject of transfer pricing is being tackled by the industry, or I would say it's being implemented, right? So today we are going to discuss about the basics of TP. So we'll be discussing on practical aspects and not on the technical aspects. We won't bore you with the technical aspects. So, Ajit, my first question to you would be, just give us a basic about transfer pricing and, why transfer pricing is required as such. We know that it's kind of a specific anti-abuse rule. But, if you can give a more background when it was introduced and what is the purpose of it? Over to you.
Thanks a lot for giving the background on transfer pricing and why we are conducting this podcast. It is very important when we talk about transfer pricing. It is very important to talk about role of tax in any economy. Tax is one of the most important source of revenue, and tax authorities across the globe are concerned about getting the fair share of tax revenue. No country would like to see any sort of wage erosion. Now, can you imagine 60% of the global trade is impacted by the related party transaction? And that's where there's a need of transfer pricing regulation. Now, the biggest question, why there's a need of transfer pricing regulations? Now, as I mentioned, 60% can be impacted by the global trade. Now, if there's a transaction between two related parties, there's always a possibility of shifting profit from one jurisdiction to another jurisdiction because of the change in the tax rates of the different countries. And that's the reason the transfer pricing is a mechanism where the regulation ensures that the transaction happening between two related parties are at fair market price or an arm's length price. And I give you a very simple example. If I, as an entity providing you services at free of cost or on a cost to cost, there can be loss of tax revenue to the local government, and that's the reason the transfer pricing regulations are important. And number of countries globally have introduced the transfer pricing regulation, and OECD over and above have been working from the years. Now, when we talk about transfer pricing, it is important to go back to the history. If I talk about the history of transfer pricing, in the 1935 it was part of Internal Revenue Code, and then in
in US.
Then in 1963 OECD Model Convention, the very important document from an international tax perspective, and one of the articles is Article 9, incorporated the arm's length principle. And then in 1979, OECD has come up with the detailed transfer pricing guideline, because the Article 9 is giving the arm's length principle, but how to implement it is detailed in the OECD guideline. And from there, we have seen number of different OECD versions of the OECD guideline. Number of countries have introduced the TP regulations. So the answer to your question is that why there is a need of transfer pricing regulations. The one is and avoiding to ensure that there is no shifting of profit from one country to another country, and that's where the countries or the tax authorities are able to avoid any shifting or protect the tax base, overall tax base. So this is the need, and there can be number of different scenarios. Like I am giving a loan, and that loan is free of any interest. There can be a loss of tax revenue to the local government. I am basically making payment to the entities, and there is no substance to the payment. Then also there can be wage erosion. So overall is protect the tax base to bring more transparencies, and that's the reason for the transfer pricing regulations.
So, long story short for the audience, transfer pricing is a mechanism to counter base erosion and profit shifting. Right, and it's really very interesting to hear that it dates back in early 19th century, early 20th century, right? And the first country to implement was the US. So today, interestingly, I heard from somewhere that our corporate tax law is just around, so just 30 odd pages, 70 odd articles. And if we see the OECD guidelines, it's thousands of pages. Right, so just that thousand and UAE, just for the audience, UAE has implemented the OECD model for transfer pricing. Right, so those thousands of pages coming into just couple of articles and one or two guides. So how does one navigate? And just to directly ask you a question, to whom it is applicable? Like if you can
Yes,
just
so you raised a very important point, and we'll, about that law, only few couple of articles in the UAE transfer pricing regulations, and then there is a guideline, OECD guideline, and FTA guideline also running into hundreds of pages. Transfer pricing is not a subject of only compliance. Transfer pricing is not only a subject of law. Transfer pricing is subject of compliance, legal, economics, substance, economics, so many things, and over and above corporate governance. And we will discuss in our discussions how about the substance is very important when we talk about transfer pricing. Coming back to your question, to whom it is applicable. Now, as I mentioned, if there's a transaction between two related parties, that's the objective, that the transaction between two related parties should be as if the parties are independent. So when independent parties deal with each other, they are not affected by the market forces. And when the two related parties, there could be a possibility that they are not impacted by market forces, but and due to this fact, there can be a price differentiation as compared to the third party. Now, the first criteria is the transaction between two related parties. Now, coming back to the UATP regulations, see, every country has a different definitions of related parties. Coming to the specific to the UATP regulations, that to whom UATP regulations are applicable, it is applicable to associated person. An associated person is natural person and juridical person. So if you are a natural person and if you are a juridical person, the transfer pricing laws are applicable, though between two natural person, it is not applicable because they are tax neutral. There is no tax, individual tax in the UAE on the natural person. But wherever the natural person and juridical person are involved, the transfer pricing is applicable. Now, it is important to mention that transfer pricing regulations are applicable to all the entities, whether it is exempted entity, free zone entity, entities claiming small business relief. The concept of the arm's length principle, which I mentioned, that transaction happened between two related parties as if they are unrelated parties. That is the arm's length principle, that you should conduct your transaction at arm's length pricing as if the parties are independent. Yeah. Now, talking about to whom it is applicable, talk about associated person, natural person, juridical person. It is applicable to all the entity. Exempted entity, small claiming relief, small entity claiming small business relief, and free zone entities. Now, there are two questions. The arm's length principle applicable to each and every, irrespective of the threshold, your transaction with the related party must be arm's length. But the transfer pricing documentation, it is not applicable to exempted entities and entities claiming the small business relief. So that's the overall difference when it comes to the applicability. But one very important aspect of the UAE transfer pricing regulation, it talks about transactions and arrangement. So if there is a transaction and if there is an arrangement also, even though that arrangement is not captured in the financial statement, that also got captured in the transfer pricing analysis.
So now, Ajit, another talk of the town, like in the tax world, is substance. Like UAE already has economic substance regulations, and furthermore, like substance has to be also taken care by corporate tax. It doesn't only apply to a free zone entity for claiming relief or exemption at 0% tax rate. It also applies to mainland entities who are not claiming exemption, which is termed as general entity avoidance rule. So just tell us, is there any link between the substance and transfer pricing, or transfer pricing is a subset of substance, or it's the other way around? If you
This is a very important question you have raised, and I give you a very interesting point here that till 2014 or 15, there were a number of countries who have introduced the transfer pricing regulation, and still there was significant amount of base erosion happening, irrespective of the fact that there were transfer pricing regulations there, and there were base erosion happening between the countries. Tax base erosion and tax authorities are concerned. OECD realized the need to come up with the BAPS action plan to make sure that the transfer pricing, not only transfer pricing regulations are implemented effectively, but there is no base erosion on account of substance. So the point what I am making here is that even your transaction is at arm's length, it does not mean that you are not it does not resulted into any it has resulted into any does not result into any base erosion. Okay, so I am giving an example here. I am paying a royalty to you, royalty at arm's length. I have been paying royalty for 10 years, but if there is no basis of the royalty payment, then there is no substance in the transaction, even if you have done the exercise of a comparable benchmarking and everything. The point I am making here is that transfer pricing is subject of business also. One need to understand the value chain, one need to understand the function analysis, characterization, and then come to a conclusion about the arm's length pricing. Your Action 8 of the OECD transfer pricing guideline clearly mention about that transfer pricing outcome should be aligned to the value creation. That is very important. That's a guideline. Article 9 is not talking about the value creation. The Action Plan 8 is value creation. So value creation is very important. Just because you have computed the arm's length price doesn't mean that your transaction is at arm's length, or basically you have made payment on a fair market price, or your transaction is according to the transfer pricing regulation. I'll give you one more example. You are availing accounting services from your related party, and you have accountant in your own company. You are paying salaries. Your transaction with your related party arm's length, but there is a duplication. You are making the same payment again to your related party and also to your own employees, and that might be challenged from a transfer pricing perspective. The point I am making here, the substance in today's world is very, very important. Even legal is there, but without substance, it is very difficult to conclude that your transfer pricing outcome are aligned to the value creation.
Sujit, that's a very good point that you made. Like, just that your royalty payment is within the arm's length range, that doesn't mean that it will fly through with the tax authorities. Like, the purpose behind it, the substance behind it also has to be seen. Like, is the brand, much value, or when you say about accounting service, that's a really good point that you made. And to conclude with, like, just for the audience, just tell what should be done now as far as the transfer pricing is concerned. See, we are already 6 months down for the first year, for the first corporate tax period for most of the companies, like who are following January to December. So it's already 6 months done. So we are left with just 6 months, the other part for the first year. What should be done? What should the industry do now?
So, this is very, very practical point you have raised, and based on my experience working in the region, transfer pricing is not only to be seen as a compliance subject, it's a subject of corporate governance. The first point I would say that treat transfer pricing is a subject of boardroom discussion, and subject where a subject of strategy, where not only you would do the entire compliance, but it can be a strategic tool to enhance your overall internal transfer pricing system. Now, compliance is the one part, because as you mentioned, only 6 months. The first point here in terms of the action point is look into all your related party relationship, identify the related party relationship. That is the first step. Once you identify the relationship, it is very important to see what do you have existing transfer pricing policies for those transactions, because this is very important to have to make sure that the transaction which you are entering into at arm's length pricing, if there is no transfer pricing policy, one should not wait for the year end to see whether the arrangement which has gone through or the transaction happened during the year at arm's length or not. this might create a trouble at the year end when we actually do the analysis and report the transaction and the disclosure form. So this is very important to see the overall arrangement. Is there a transfer pricing policy in place, whether the policy is at arm's length or not. And another important one, having the internal control framework in the place internally, because I have experienced many a times, data is very difficult to collate when it comes to the related party transactions. So having internal control, a framework system in place, solve most of the transfer pricing problems, not only internally but also it helps with the tax authority also in the time of audit if you have internal control framework in the place. So the point I am making here is that the transfer pricing not only helps to bring more transparency in the system, but also it improves the overall internal system. It reduces the overall cost in terms of managing the internal arrangement. So these are the all action points helping not only in the compliance but also reduces the risk from an audit perspective.
So Ajit, to echo what you said, like the transfer pricing travels way beyond the tax compliances. It also carries the corporate governance and thereby improves internal efficiencies. We have seen in the developed tax economies that the corporate governance carries a huge image for the company. So any company over here wouldn't want to end up in the bad side of the public, right? So as the UAE progresses to a compliant economy from the non-compliant economy. So guys, hope we were able to add value to you, and do let us know if you have any questions, and happy to get feedback from you. Thank you.
Thank you, Riddhesh, for your insightful question. Hope I will be able to answer based on my experience and it would help the overall audience for our podcast, and we'll come back with a more insightful podcast on the interesting topic of transfer pricing.
Definitely. The audience loves it. Thank you.